HMRC quietly updated its guidance on allowable expenses for limited company directors in 2024, and the average director running a small limited company is leaving over £3,000 a year on the table because they don't know what actually changed. Text overlay: £3,000 plus unclaimed per year, average small limited company director. If you run a limited company, even a one-person consultancy, a side hustle that you've incorporated, or a small agency, this affects you directly. Here's the thing most directors don't realize. Your company and you are legally separate entities. That means the rules for what your company can pay for, and what you personally can claim, are completely different from what a sole trader does on their self-assessment. An HMRC's updated Employment Income Manual, cross-referenced with the 2024 autumn budget changes, has shifted the line on several key categories. Text overlay: HMRC Employment Income Manual, updated 2024. Get this wrong and you're either overpaying tax unnecessarily, or you're claiming things you shouldn't and flagging yourself for a compliance check. We'll get to exactly which expenses changed and how to claim them properly, but first, you need to understand why most directors are structuring this completely wrong. 1 to 330 problem. Most one-person limited company directors run their expenses like they're still a sole trader. They mix up what the company claims, what they claim personally through self-assessment, and what counts as a benefit in kind, which is a completely different category that triggers national insurance for both sides. Here's a real scenario. Sarah runs a one-person marketing consultancy through a limited company. She earns £35,000 a year as a salary. Actually, like most directors, she takes £12,570 salary to stay at the personal allowance, and draws the rest as dividends. She's been paying for her broadband, her laptop, her phone contract, and her professional subscriptions out of her personal bank account, and then trying to claim them back on her self-assessment. That's wrong. And it's costing her. Text overlay: wrong approach equals double tax exposure. When you pay business expenses from personal funds and don't reimburse them correctly through the company, you lose the corporation tax deduction. The company should be paying, or formally reimbursing you, so the cost comes off the company's profit before corporation tax is calculated. Corporation tax is 19% for profits under £50,000 in 2025 to 26, or 25% for profits over £250,000. Every pound of legitimate expense you miss is taxed unnecessarily. But here's the part that almost nobody talks about: the line between what's allowable and what HMRC classes as a personal benefit has shifted. And if you're not aware of the specific updates from the last 12 months, you could be claiming things that now carry an unexpected tax charge. 3:30 to 10 o'clock, solution. Let's go through the 5 categories that matter most. These aren't theoretical, these are the ones HMRC flags most frequently in small company compliance checks. 1. Home office costs. If you work from home as a director, your company can pay you a use of home allowance. HMRC allows a flat rate, currently £6 per week, or £312 per year, without you needing to justify receipts or calculate room ratios. Your company pays it to you, it's not a benefit in kind, and the company gets the corporation tax deduction. Text overlay: £6 per week flat rate, no receipts needed. But, and this is where people leave money behind, if your actual costs are higher, you can calculate the actual proportion of household bills that relate to business use. We're talking mortgage interest or rent apportioned by room and hours, electricity, heating, broadband. For a director working from home full-time, the actual calculation often lands at £40 to £80 per month, far above the flat rate. The key rule: you need a genuine, dedicated workspace. Using the kitchen table doesn't count. A room, or a defined portion of a room, used exclusively for business during business hours does. Before we move to number 2, the next category is one where HMRC updated its guidance specifically in 2024, and it's the one most directors are getting wrong right now. 2. Mobile phone and technology. Your company can pay for one mobile phone contract per director or employee, fully tax-free, no benefit in kind, as long as the contract is in the company's name. Not yours personally. This is the change that tripped people up after HMRC clarified its position in updated guidance cross-referencing EIM 21779. The contract ownership is everything. If you're currently paying for your phone personally and your company reimburses you, that reimbursement is potentially a taxable benefit. The fix is simple: get the contract moved into the company name at renewal. Text overlay: contract must be in the company's name, not yours. Same principle applies to laptops and equipment. Your company buys them, not you. If you already own equipment and want the company to use it, the company can pay you a rental charge, but the paperwork needs to exist. 3. Travel and mileage. If you use your personal car for business journeys, not your commute, actual business travel, your company can reimburse you at HMRC's approved mileage rates. For 2025 to 26, that's 45p per mile for the first 10,000 miles, then 25p per mile after that. Text overlay: 45p a mile, first 10,000, 25p a mile, after 10,000 miles at 45p is £4,500, completely tax-free to you, and a full corporation tax deduction for the company. Most directors with any client-facing work are doing well over 3,000 business miles a year. That's £1,350 of untaxed reimbursement they may not be claiming. The catch: you must keep a contemporaneous mileage log. Date, start point, end point, business purpose, miles. HMRC doesn't accept estimates in a compliance check. The next category is the one most directors never even think of, and it's potentially worth hundreds of pounds every single year. 4. Professional development and subscriptions. Your company can pay for training and professional development that's relevant to your trade. The updated HMRC guidance, specifically clarified after the 2024 budget consultation on upskilling, confirms that courses, certifications, and industry memberships are allowable as long as they relate to your existing business activity. Text overlay: training must relate to your existing trade, not a new one. That's the precise line. A web developer paying for an advanced JavaScript course, allowable. The same web developer paying for a course to become a personal trainer, not allowable. The company can't fund career pivots. Professional memberships, CIPD, ACCA, CIM, whichever professional body applies to your sector, fully allowable when the company pays directly. Business books are allowable. Your Netflix subscription is not, unless you're a media consultant and you can evidence the business use in writing. 5. Pension contributions. This is the single most underused legitimate tax strategy for limited company directors, and it's gotten more important since the 2024 autumn budget confirmed the freeze on income tax thresholds continues through 2027 to 28. Text overlay: employer pension contributions equals corporation tax deduction plus no NI. Your company can make employer pension contributions directly into your pension. These contributions are not subject to employers' national insurance, that's 15% in 2025 to 26 after the rate rise confirmed in the autumn budget. They're not subject to income tax for you. And the company deducts them in full against corporation tax. The annual allowance for pension contributions in 2025 to 26 is £60,000, though it's limited to your relevant UK earnings, which for most owner-directors includes your salary but not your dividends. If you're taking a £12,570 salary, your pension-eligible contributions from salary are limited, but you can also make personal contributions and claim higher rate relief if applicable. Text overlay: annual pension allowance, £60,000, 2025-26. The key action: if your company hasn't made any employer pension contributions yet this tax year, this is the most efficient thing you can do before the 5th of April, 2026. 10 to 12:30, proof. Let's run the numbers on a realistic one-person limited company. Profit before expenses, £60,000. Same business, two different approaches. Director A claims nothing extra. Pays corporation tax on £60,000 at 19%, that's £11,400 gone. Director B uses the legitimate expenses we've just covered. Home office, actual calculation, £720 per year. Mileage, 5,000 business miles at 45p, £2,250. Mobile phone contract in company name, £600. Professional membership and training, £800. Employer pension contribution, £5,000. Total additional deductions, £9,370. Text overlay, £9,370 in additional deductions. Corporation tax saving, 19% of £9,370 equals £1,780. And that £5,000 pension contribution? Director A paid it as a salary top-up instead, triggering 15% employer NI, £750, plus income tax. Director B's pension contribution, no NI, no income tax. The difference on that one decision alone is over £1,500 in the director's pocket. Text overlay, £1,780 corporation tax saved plus £1,500 plus NI income tax avoided. The HMRC deadlines that matter here: corporation tax for your accounting period is due 9 months and 1 day after your year end. If your company year ends the 31st of March, 2026, your CT payment is due the 1st of January, 2027, but your accountant needs these figures before then. The time to get the expenses right is during the tax year, not after it closes. Text overlay, don't wait until after your year end, get this right now. 12:30 to 13:30 CTA. Here's your one action for today. Pull up your last 3 months of personal bank statements and your company bank statement side by side. Find every payment you've made personally that was a genuine business cost. Add it up. That's the money your company should be reimbursing, or should have been paying directly, and the corporation tax deduction you've been missing. If that number surprises you, and it usually does, take it to your accountant before your company year-end closes. Or if you don't have an accountant yet, that conversation is now overdue. The video that makes sense to watch next covers how to structure your director's salary and dividends for 2025 to 26, because getting your expenses right only saves you money if your overall extraction strategy is also optimized. That one's up on screen now. This video is for information only, not financial advice. Always speak to a qualified UK financial advisor before making decisions.